I've got a series of charts that push back against those who insist that wages are not increasing. This is courtesy of Torsten Slok, the international chief economist at Deutsche Bank Securities. And our first chart, Mark, shows how employer costs for employee pay, for instance, how much a Walmart or TJX pays their staff, has been creeping higher. I cite them, as you know, because both have announced they'll be raising wages for their U.S. workers starting in June. The main thing to focus on here is the far right side of the chart, that move higher since the middle of last year. On a year-over-year percent increase basis, the last time, Mark, we saw employer costs rise this much was in 2006.
Is this a good thing? Because what we have talked about on this network for the last several years has been wage stagnation, that people are not getting paid even though the economy seems to be doing better.
Well, these charts are designed to show that perhaps they are creeping up in other parts if you slice and dice the data different ways. Another way of looking at this is on bonuses, and these are not Wall Street bonuses per se, because those increased 3% according to the New York State Comptroller, and this is a lot more than that. This is a similar trajectory, if we can pull that up, Jamie, which shows it creep up at the very end of the chart. The increase, in fact, has gone through the roof the last few quarters, 45% year over year, surpassing what we saw in 2006. I asked Torsten Slok about this because that's a sizable increase. Yep. He says it could be the result of companies shifting their pay structure from fixed compensation to more variable structures, incentive pay, in which workers share the risk of downside. So that might be one explanation. It could also be better corporate earnings and employers being generous with their employees.
Okay, we're talking about the United States. We're talking about a services-dominated economy. Yes. How do the wages break down across sectors?
Well, it's probably not a huge surprise that the hot industry, technology, and if we could pull up the chart, is leading the way. It is the red line there, the outlier. Trade, transport, utilities, the purple line is the laggard there. I know Tom Keene would have a heart attack if he saw this chart. There are too many lines. I mean, but ignore the jumble of lines there. What you want to focus on is that all six sectors, all six lines, show a move higher over the past year. The big picture for this chart, according to Torsten Slok and the two previous charts, is that 1 year ago there was no obvious sign of wages going up. Now we're starting to see a sustained increase, and that shows the trend is changing. And since you're old school, Mark, I've also got an old school way of slicing and dicing wage growth for you. Unions versus non-unions.
There you go. Yep.
Wages for union workers, the white line there, rising faster than those for non-union workers, the yellow line. Of course, union membership, as you know, has been falling rapidly, so this could be misleading. But for those who do belong to unions, they appear to be better paid now.
Okay, if average hourly earnings not showing a pickup, overall inflation still below that 2% target, is the Fed paying attention to all of this data?
Torsten Slok says they can't afford not to pay attention to all the data. She, meaning Janet Yellen, is not going to hang her hat on average hourly earnings, and that's it. Yeah. So they're paying attention to all of this. The market has been reluctant to embrace this because for the past 5 years, they've been wrong on interest rates and when the Fed will raise. And they're comfortable with that idea that the Fed will stay on hold for as long as possible.